Well, we're now into the 1980s, and in 1987, the SE chairman protected the FASB from an attempted takeover by the Business Roundtable, which wanted to gain control over the board's agenda, reflecting industry's increasingly heavy-handed lobbying of the board. The Business Roundtable is an organization of some 200 chief executive officers of some of the most important companies in the United States, and they have a committee that deals with accounting issues, chaired by an individual who headed up Citicorp, John Reed. And they were getting increasingly concerned about some of the issues that were coming on the agenda of the FASB, which they preferred not be on the agenda of the FASB, like accounting for pensions and accounting for employee stock options. So in 1987, John Reed wrote a letter to the chairman of the SEC suggesting that a new committee be set up that included, among other people, representatives from industry, as well as the SEC could be on it, that could have influence over the FASB, either directing it to add something to its agenda or remove something from its agenda. And this was rejected totally by the chairman of the SEC, who said, we are the person who has oversight over the SEC, and we don't need industry or anybody else to join with us. So fortunately, in this case, the SEC protected the Financial Accounting Standards Board from an attempted takeover by industry. This was the first of two. We'll see a later one in the 1990s. Obviously, industry feels very strongly about the impact of its standards on its financial reporting and is willing to fight for it. In 1990, the board approved a standard which required companies to show an accrued liability for large sums of post-retirement healthcare costs, which they had been accounting for on a pay-as-you-go basis, leading to a more rational management of these costs and lending credence to the maxim that you manage what you measure. This is quite interesting because apart from pensions, there were many other healthcare costs which were covered by companies for their employees, which were agreed to for long periods of time. But when the commitments were made by companies to cover these healthcare costs, they did not make an entry setting up a long-term liability or debiting any kind of an expense. They simply waited until the payment had to be made, and in that period, they would record an expense, and they would credit cash. The FASB felt this should be accounted for on an accrual basis, namely as soon as the commitment is made, by which the company has agreed to make payments for certain kinds of healthcare costs to certain classes of employees over specified periods of time, there should be a recognition of the liability at this point. And so they issued Statement 106 in 1990, which was very stoutly opposed, especially by some of the old line corporations, because of the impact that it would have on their financial statements. For example, when many companies adopted it immediately and you had a chance to make a one-time change immediately, General Motors' change was $20.8 billion of an expense they would have to recognize now, and a liability they would have to recognize now. And the expense, once it was recognized, would be 3/4 of the company's shareholders' equity. It was just wiped away by this one-time adjustment to the new standard. For Chrysler, the amount was $4.7 billion, which exceeded its retained earnings balance. So you see, the impact of the one-time charge that many companies took had a considerable impact, adverse impact, on their financial statements. But the FASB would say, this has always been the case. You simply have gotten around to recognizing it only now. As a result of this, quite a number of companies recognizing what liability they had committed themselves to began to engage in a much more rational management of the incurrence of these costs. And a few companies tried to removed themselves from some of these costs, as some of the labor unions were concerned that companies might stop making available many of these health care benefits because they have begun to realize just how much they gave away. And as I've said, it lent credence to the maxim that you manage what you measure. And so if you actually measure something, you're more likely to manage it. Many people have said this is one of the real successes of the FASB. It not only accounted in a more sensible way for the post-retirement healthcare costs, it also induced a certain amount of more rational management of the incurrence of these costs on the part of industry. In the early 1990s, spurred on by the chair of the SEC, the FASB tried to issue a standard requiring marketable securities to be shown at their current market values, with gains and losses taken to income. This began a fairly long period by which financial instruments began increasingly to be accounted for by fair values. In the past, the SEC had opposed fair value accounting for property, plant, and equipment, and as far as we know, they still oppose it, but we don't know its current position. But when it came to financial instruments, many of which, of course, are traded actively in the market, but certainly not all of them, the SEC has been much more relenting to accept fair value accounting. And so Richard Breeden, who was the chairman of the SEC in 1990, believed that it would be sound accounting if the FASB were to attempt to make a move toward fair value accounting in the easiest possible area, namely marketable securities, securities for which there is an active market. So there isn't a subjective judgment to be made about their current market values. The gains and losses would be taken to income. Well, the banks did not necessarily agree with this, the banks and the bank regulatory agencies, because banks tend to hold very large portfolios of debt securities. And as the market fluctuates, the income of the banks would fluctuate if they had to record those securities at fair market value and take the gains and losses to income. The banks did not want to report volatile gains and losses from one period to the next as market values fluctuated. And the securities market, the bank regulators, particularly the Secretary of the Treasury and Alan Greenspan, the Federal Reserve Board, were very concerned about the impact on the fragility of the banks, making the financial system look as if it was more fragile than it was before. It might cause a credit crunch because as a result of declining market prices for the bonds, this would reduce the capital of the banks and make it harder for them to lend. So the banks were very concerned about the impact of this proposed standard on the viability of the banking system and the image of the banking system being a solid part of the financial system of a country. And so the banks and the regulatory agencies vociferously opposed the proposed standard and forced the board, with support from Congress, and now Congress begins to get involved more and more, to allow the holders of the securities to classify them in such a way as to avoid having to take the gains and losses from changing market values to net income. And this gave rise to this three-part classification for debt and the two-part classification for equity securities investments. So for investments in equity securities, they would be traded as either, they would be shown as trading securities or available for sale. These classifications would be made by the investor, the company. For trading securities, ones you expect to get rid of fairly soon, you would take the gains and losses into net income. For available for sale, you would park them in a section of shareholders' equity, but would not allow them to get into the income statement. And of course, virtually all holders of investments in equity securities preferred to use available for sale and to lodge the unrealized gains and losses in shareholders' equity and wait until they actually sold them before they got into net income. All the investments in debt and equity securities would be shown in the balance sheet at fair value. But in the income statement, the difference would be made. For investments in debt securities, there would be trading and available for sale as well. Again, the decisions made by the company as to how they classify them. But there would be a third category for debt, which is held to maturity, meaning you expect to hold on to them to the very, very end. And there you would account for them by historical cost, and you would amortize the discount or premium, if any. And so finally, this standard came out in 1993, Statement Number 115, where fair market value is used for investments in equity and debt securities accounted for as trading or available for sale, but that any unrealized gains and losses on the available for sale securities would not find their way into net income, but would go into shareholders' equity and would not be in any statement of performance at all. And the FASB was not at all satisfied by this, but they were defeated by the banking industry. When the banking industry, especially the American Bankers Association, a very powerful agency, gets involved in an accounting standard, it is very difficult to fight them. And this was one of the first great losses to the banking industry. As I say, this intense campaign of lobbying by the banks represented the beginning of a disquieting trend for industry lobbyists to appeal to members of Congress to apply pressure on the board via the SEC. Now, of course, the first thing the banks would do, or any companies or interested parties who would object to a proposed standard would go to the SEC to try to persuade them not to do something or to do something differently. If they felt that the SEC wasn't listening, which meant they didn't agree with them, their next step would be to go to a member of Congress in the Senate or the House, preferably one to whose campaign they had contributed funds, and saying, we have a problem with the Financial Accounting Standards Board. We need your help in stopping the board from issuing a standard. Now, the board, the FASB, is a private sector body. If they want to issue a standard, they can, and there is nothing that Congress can do to stop them. However, the standard is applied by companies only if the SEC requires that they comply, and the SEC is a creature of Congress. So how does Congress get to the FASB? Through the SEC. They file a bill which directs the SEC not to require companies to conform to a certain standard, and they describe the standard should it be issued. If you're in favor of the standard, you would direct the SEC to require companies to follow the standard. So the way that the Congress got to the FASB was by ordering the SEC either to require compliance with the standard or not to require compliance by the standard. And this began to happen very soon. Between 1992 and 1995, the FASB tried mightily to issue a strong standard on accounting for employee stock options, requiring companies to charge the cost of the options calculated by the use of an option pricing model to net income. This had been a problem that had been festering for a very long time. The use of employee stock options to compensate executives and indeed other employees of companies had been going on since about the 1970s and grew considerably in the 80s and the 90s, to the point which, by the early 1990s, the lion's share of top executive compensation was composed of employee stock options. The stock market had been rising, and this was a great way to compensate employees. The problem had been, in the absence of option pricing models, it had not been possible to know what the expense was to recognize on the part of the companies issuing the stock options. There was simply no objective guide or measurement, because when you issue the options, in order to get all the tax benefits that you would need to get, the company would need to set the exercise price, that is to say the price paid by the employee or executive in order to exercise the option, no lower than the market price prevailing at the time you grant the options. Well, since typically the exercise price equaled the market price at the time of granting the stock options, what is the amount of the expense? The two are the same. The hope is, on the part of the employee or the executive, that by the time exercise is possible, the market price will have increased considerably such that it is above the exercise price, and therefore there is a clear benefit by exercising the stock options. So as a result, companies had been issuing stock options for several decades, and unfortunately it had not been possible to say what the expense is. It is simply an element of compensation for which no expense was recognized, although everybody believed there had got to be an expense because the employees believed there was a benefit. And so the question is, what has to be done about it? Well, once option pricing models were developed in the 1970s, it was believed that if you could use an option pricing model that would have certain variables inputted in it, such as expected volatility in the price of the stock and expected future dividends, that the option pricing model would finally give the company an estimate of the value of the options. And that estimate of the value of the options would become the expense that the companies would recognize in their financial statements. And that is the route that the FASB began to take in 1992 and 1993. Well, companies didn't like that. They enjoyed this free game they were playing, by which they could issue options and have no expense. And now they could see that as they issued more and more options, they would have to recognize expense, show lower income, and therefore shareholders might not favor this form of compensation so much because their net income would be lower as a result of issuing more and more stock options. The problem was particularly acute in the tech industry, especially Silicon Valley, which for years had been compensating not just their top executives, but virtually all their employees with stock options. They didn't have enough cash to pay them solely by cash, and the employees were very glad to have a piece of the action of a company they thought would be a model of great profitability in the years to come. So they were glad to get the option to purchase shares of stock in lieu of cash. Consequently, if an expense was going to be shown, the high-tech companies in Silicon Valley and elsewhere around the country would recognize that they would have to show much larger expense because the options are going to virtually all their employees, and the materiality would be much greater. And the ones that were showing low income would be showing losses, and the ones that were showing losses would show mountainous losses. Consequently, there was alarm in the entrepreneurial high-tech field that this required recognition of expensing by using option pricing models would be disastrous for the industry. And anytime you speak against high-tech or entrepreneurial activity, you're asking for interest in Congress. And the matter very quickly went to Congress. Companies, especially those in the high-tech sector, held a protest demonstration. This was in the San Jose Convention Center, appealed to members of Congress and even to President Clinton in a bid to ward off the standard. The pressure from Congress was intense. Interestingly, in May of 1994, while all of this was going on, and Congress was getting very active in holding public hearings and writing letters to the FASB and writing letters to the SEC, members of Congress, saying this is bad for the economy, bad for the entrepreneurial sector, bad for Silicon Valley. We've got to encourage the growth of these, not in effect limit their growth. And so it became a public policy, not just a matter of proper accounting, that in 1994, in May, the Senate on the same day passed two resolutions with overwhelming support. The first one was urging the FASB not to require the expensing of employee stock options. The second one, which was kind of an expiation of guilt that was supported by a certain number of the members of the Senate who favored what the FASB was doing, said that Congress should do nothing to impair the objectivity and integrity of the FASB's operating decisions by issuing legislative rules, which of course is just what they had done. So these two resolutions passed by Congress on the same day, May 3rd, 1994, had opposite intentions. One saying you shouldn't do it, and the other said we shouldn't be telling you shouldn't do it. Rather interesting what was going on in Congress. And then a bill was proposed by a particular senator that really was thought to threaten the future viability of the FASB. It in effect said that every time the FASB issued a standard, the SEC would have to hold a public hearing, and each member of the SEC would have to vote to decide whether this should be part of generally accepted accounting principles. Well, if that were the case, what would be the point of the FASB? The SEC would have to repeat everything the FASB did, and it would therefore make the FASB redundant. And the SEC didn't like this at all and didn't want to have to replace the FASB. And so the chairman of the SEC had a private meeting with the members of the FASB saying, this is a very damaging bill. If it goes into effect, it's going to mean the end of the FASB, and we don't want to see the end of the FASB. And so the SEC chairman said, you've got to back off. You've got to come up with something that doesn't threaten the entrepreneurial, the high-tech industry. So finally, in 1995, the FASB issued its standard, and it said that the expense does not have to be recognized in the income statement. It has to be recognized only in the footnotes. So where a company has issued stock options and has elected not to show it in the income statement, the expense, which is all but two of them actually, you have to show in a footnote the effect of issuing stock options on net income and on earnings per share, a kind of pro forma analysis. Companies don't feel threatened by footnote disclosure. They do feel threatened by something in the body of the financial statements. So as a result, everybody could live with this. And the standard came out, and later the chairman of the SEC, Arthur Levitt, confessed that the worst decision he made while he was chairman was advising the FASB not to go ahead and issue a standard that would have required the recognition of expense in the body of the income statement. So this was a very, very difficult standard to issue. It's not the one that the board wanted to issue at all, but nonetheless was forced to by enormous pressure brought by Silicon Valley and essentially the entrepreneurial sector, as well as by many other large corporations. As I say, numerous bills proposing legislation were introduced in Congress either to support or oppose the FASB by ordering the SEC either to require company compliance with the board standard or forbidding the SEC from enforcing compliance with the board standard. And it was interesting, those bills had been authored at the same time, and they were contemporaneous in the Senate and the House. In the end, the cumulative effect of all these pressures led the board to require companies instead to display the impact of the employee stock options on net income and earnings per share in a note to the financial statements. Only two publicly traded companies, Boeing and Winn-Dixie Stores, decided voluntarily to show the expense from employee stock options in the body of their income statement. And then finally, in the mid-1990s, another attempt to gain control of the FASB by industry. This time, the Financial Executives Institute attempted to gain this control, but the SEC chairman, this was still Arthur Levitt, once again intervened, another SEC chairman that protected the FASB from industry takeover, by forcing the FAF's trustees to replace several of its industry trustees by four who represented the public interest, so as to dilute the FEI's influence over the FAF and the FASB. Once again, the industry wanted to control the agenda of the FASB, to order it to take certain things off the agenda, to order it to add some matters to its agenda. Mostly they were interested in having it take items off its agenda. And the effect was that at the end of this activity, that the FAI had even less influence over the FASB than it had when it began its attempt at the takeover in the middle 1990s. All because Arthur Levitt and before him, Chairman David Reuter in the late 1980s stepped in to defend the FASB against an industry takeover. And this shows the extent that industry was willing to go to try to control the efforts of the Standard Center so that it could use the kind of accounting it wanted to use without being told it cannot use that kind of accounting by the Financial Accounting Standards Board. Lobbying has become a much greater issue in the 1980s and the 1990s. And going to Congress, as I've mentioned, when you can't get satisfied by the FASB or the SEC, also became a more common practice.